Good morning, everyone, and welcome to the Big Buzz Breakfast Club. I'm Melissa Legowski, founder, CEO, and Queen Bee at Big Buzz Idea Group, and we are excited for today's presentation about key investment and philanthropic trends for fiduciaries. Just a couple of housekeeping notes. This session is being recorded and will be shared with you via email and a post-event follow-up. That way you can share it with team members and board members as appropriate. Please do put any questions that you might have in the Q&A today, and we will address questions at the end. I know that Sepora has a lot of great information she wants to share with us, and so we know as she moves through her presentation, she may have answers to those questions, but we want to keep building as we go, and we will circle back on all of those items at the end of the presentation. And then if you would like to turn off the closed captioning today, please click the button at the bottom of your screen and simply select Disable. If you are not yet familiar with Big Buzz Idea Group, I am a former executive director myself, and after being stretched incredibly thin, I created Big Buzz Idea Group to really be an outsourcing partner for nonprofits and associations who just need some support and a team that really gets it. We know that many nonprofit executives lack the time, staff, skills, and funding that they need. Big Buzz Idea Group fills gaps in management, marketing, and event services so that you can focus on the big picture and position your organization to thrive. This morning, we welcome Sepora Badower, who is a vice president and financial advisor at Bernstein Private Wealth Management. I'm excited at this time to bring Sepora to the screen and allow her to share her presentation.
Thank you, Melissa. Hi, everyone. It's such a pleasure to be here, and thank you to Big Buzz Idea Group for having me this morning. I will just share my screen, and I'll send these materials also, Melissa, over to you so that you can share with the rest of the group. Okay, perfect. And all of you should be able to see my screen. Let me know if not. Okay, wonderful. All right. So I'll start by just giving a quick high level on who we are at Bernstein. As Melissa mentioned, I'm a vice president and financial advisor at Bernstein. I've been with the firm now for 7 years, and our focus is really investment management and research. And we use the research that we do to really ensure that we are working with our clients to ensure their best outcomes and really help meet their goals. As part of that, we've been working with nonprofit organizations since really the beginning of our inception, almost 60 years ago. And as I mentioned at the beginning, we are only focused on research and management. And as a result of that, it's really easy for us to be a fiduciary and to have our interests completely 100% aligned with our clients. So I just mentioned our focus in working with nonprofits. We actually have a portion of our firm that's just dedicated to the foundation and institutional advisory space. And our approach is really holistic. You'll see some of the things that I'm talking about today around investment and spending policies, risk and reserve analyses, things like your, thinking through how to ensure that you're really keeping up with trends that we're seeing in terms of philanthropic giving. So in addition to all of that, we also do 403Bs. So we're really able to holistically partner with the clients that we work with, educational seminars for boards and staffs, et cetera, et cetera. And I've listed some of our sample clients on the other side of the page. All right, so that brings us to today. As all of you know, as we're all experiencing it, there's so much uncertainty and so much transition afoot in our economy, in the markets, the business of philanthropy, and generational shifts. So as really the fiduciaries, financial decision makers of foundations and nonprofits, a question I often get asked from all of you is, how do we really make the right decisions with all of this in mind? So today I'll walk through a top 5 list of actions that fiduciaries can take to help weather the environment ahead. Once you receive the materials, if you hover over each of these icons, you'll have access to further content that we've produced on each. So more specifically, one of the questions I get is, how are we advising clients on the environment as we look ahead? At Bernstein, we have a proprietary system that considers relationships between asset classes and the current environment. We call it our capital markets engine. This helps us to dimension for our clients what they can expect as they look at their portfolios over the course of the next 10 years. So let's talk about investment policies. Your investment policy should be the document that you use to reference as a guideline in times of stress, but really in all times. This only works, though, if it's relevant and updated both around current and expected activity at your institution and current and expected market conditions, like I just showed you on the prior page. We have organizations that come to us all the time, and they have policies that are outdated and irrelevant, policies that are set up for entirely different environments. And it's our job to advise them. Often these organizations will ask me, how are you measuring success? Specifically, how do we know if we're doing well? Well, we recommend a risk-weighted benchmark. So if your portfolio has a risk profile of, let's say, 70% stocks, 30% bonds, what is the advice around this? That's really taking into account alternative assets, active managements and leanings from a return and a risk perspective, especially if we're adding new types of assets into the mix. What are the cost structures and our reported return net of all fees? Cost matters. So those are all questions that you should be asking as fiduciaries. And we, as an investment advisor, recommend re-ratifying this investment policy annually and really using this also as an onboarding tool for new fiduciaries. If you don't have an investment policy, that's okay. We have templates to get you started, so feel free to reach out afterward, and I'm happy to provide you with one of those. So I'd be remiss if I didn't talk about the recent banking sector fallout that we've seen. So a lot of the questions we've received this year are around cash. Is it safe? What about insurance? What's going to happen if there's financial institution failure? So most audience members are likely familiar with FDIC insurance, which protects depositors around a loss if an insured bank fails. Standard coverage is $250,000 per depositor. Far fewer people are normally familiar with SIPC insurance, Securities Investor Protection Corporation insurance. Like the FDIC, SIPC protects customers if an insured brokerage firm fails. Standard SIPC coverage is $500,000 per client, $250,000 of which can be cash. Two things to note: firms can purchase excess SIPC coverage. So, for example, Bernstein SIPC coverage is up to $50 million per client. So we've increased our overall coverage, of which $1.5 million can just be in straight cash. Certain money market funds, though, are actually considered investments for the purpose of SIPC coverage. So I have clients, for example, that have a larger portion in money market funds and those are completely covered under the $50 million. Key considerations and actions for social sector organizations in this environment: credit may be tougher to access, and bank financial pressures could result in the reduction of philanthropic support. So please discuss with your bankers the relative health and implications for the bank. Confirm the terms of your lending and philanthropic relationships, and right-size your cash. So reserves should really be sized. I just mentioned right-sizing your cash based on factors impacting your shortfall risk. Some of the frequent conversations and questions we've been having with clients are centered around cash management. You need to keep enough cash on hand to cover expenses in the near term, but not too much, because you want to minimize the amount that's losing its purchasing power over time. There is no one solution for sizing reserves. It depends on the specific mix of factors that impacts your organization: revenue risk, spending risk, timing differences, borrowing risk, or ability to borrow and at what cost in the near term. We've received so often the question around, how much should we hold in reserves? How should we allocate various buckets that are in our endowment or our long horizon account? So we as a firm built a reserves analysis. It's a questionnaire asking about those 4 risk areas: revenues, spending, timing differences, and borrowing ability. And we run this data through our reserve tool and come back to organizations with preliminary recommendations on both sizing and allocation for these asset pools. Definitely feel free to reach out to me on this. So we also recently released a podcast around NACUBO's 2022-2023 report. This is a massive amount of information read by funders and board finance and investment committees, as well as professionals across the social sector. So I thought it would be prudent to highlight some of these key findings. Many of you may be familiar with NACUBO. While the data is limited to 800 or so college endowments, it's reflective of the broader social sector and one of the most widely used reports on long horizon investments of long horizon tax exempt portfolios. If we look on this page, we see that the largest institutions, so the 1 billion plus or close to that, have a much larger portion of their portfolios in the purple and light yellow, private equity and venture capital, as well as marketable alternatives. This fiscal year, alternatives comprised over 50% of these portfolios, with only 30% in public equities, 10% in fixed income, and 12% in real assets, or a proxy for inflation-sensitive assets. These largest institutions have already been inoculating themselves in large part from the whiplash that retail investors might experience from the whims and the fears of publicly traded markets. Scoot over here to the right to the smallest qualified purchasers in that $25 million to $50 million range, and accredited investors in the sub $25 million range. And you see nowhere near that adoption of either. Far more exposure to traditionally long-only publicly traded securities, far less exposure to inflation-sensitive assets. I'm definitely not espousing that a smaller organization should look to replicate a $3 billion portfolio. But what I am trying to suggest is that the smallest organizations have catch up to do. You can see here that the largest institutions posted much stronger performance this fiscal year than those on the smaller end spectrum on the right. But there are offerings with different sources of return and risk than publicly traded stocks and bonds that could offer lower volatility and/or higher returns looking ahead. So we'd be advising in many cases somewhere around 10% in inflation-sensitive assets where appropriate, and 20 to 30% of the long horizon portfolio and alternative investments, different source of risk and return, especially for those accredited investors. Another continuing trend reflected in this fiscal year's NACUBO report is the increasing percentage of endowments that factor responsible investing into their investment managers' due diligence and evaluation process. This fiscal year, it reached greater than 50% of respondents. Now, many of the same barriers to implementation of ESG, so environmental, social, and governance, or SRI, socially responsible investing, or impact investing were reported. A few facts we highlight for clients is that aligning investments with your mission in some way does not have to be an all or nothing endeavor. There are investment services out there that outperform relative benchmarks. So it doesn't have to be giving up performance. There are ways to incorporate this without conflicting with fiduciary duty. Like all things in investing, one size does not fit all. We published a piece on fiduciary duty and ESG investing this past year that you can access if you just click on that earlier icon. Okay, let's talk about diversity, equity, and inclusion. The fact that this is now measured is really a statement in itself. We now have 2 years of data reflecting an increased percentage of respondents implementing a formal policy that integrates diversity, equity, and inclusion into their investment manager selection, particularly at smaller institutions. Who owns the firms? Who makes the investment decisions? Who's on our client-facing team? Those are all important questions that organizations are now asking. We researched who the portfolio managers and decision makers are leading the investment strategies in our foundation institutional portfolios at Bernstein. And in the most commonly adopted portfolio allocation, well over 50% of the portfolio managers are women and people of color. So way ahead of the industry, according to a report by Knight Foundation. But we're still seeing spotty and inconsistent data across the industry. So these are questions that you should be asking if this is something that's important to your organization. All right, so let's dive into the 5 philanthropic trends for 2023. And let's start with the Giving USA, kind of this mixed bag that we've received. Before I even say that, as an advisor, I do want you all to know that I work with many families who are also giving through a variety of philanthropic strategies and vehicles. So given the backdrop and our work with nonprofits, foundations, and other donors around the country, I think it's important to dig in to some of these because they're key trends not only for you all as organizations, but also that we're seeing on the fundraising and funding side. So a consistent trend has developed in recent years across the US, where overall philanthropic giving continues to grow overall, but the number of donors is relatively shrinking. So we're seeing more multi-million-dollar gifts, major gifts, but with the exception of some very successful virtual campaigns, we're seeing fewer annual gift types of contributions. In fact, individual giving declined by 6.4%, while foundations, bequests, and corporations have all increased. Adjusting for inflation of 8% in 2022, the actual impact to organizations is really down 10.5%. So it's really significant. So let's talk a little bit about planned giving. I just shared a big reason as to why planned gifts matter, given the overall direction in terms of gift size and number of donors. But in case you need more convincing, I'll highlight a few more factoids. Approximately a third of Americans have stated that they would consider including a charitable bequest in their will or estate if they were asked. I'm just going to pause for a moment and let that sink in. If they were asked. So we need to be asking these donors. Planned gifts continue to increase by 5% annually despite the economic environment, which makes sense because, of course, it's less taken out of an individual as they are currently using those funds to combat inflation. Studies also show that a donor's current giving increases very dramatically after including an organization in their estate plan. So if you are getting ahead on planned giving and bequests, you will also see the impact of that during the donor's lifespan. Another hot topic right now is this idea of giving in community. Donors and funders are reaching out to each other and to community-based practitioners or grantees to partner for increased education and impact. Giving circles are rapidly growing. I actually attended a giving circle event last week. Donors are forming voluntary associations, they're pooling finances, and they're putting time together to decide, really decide how to allocate resources. Across geographies, issue areas, demographics, Global Giving Circle Directory is actually really worth checking out for donors and for funders. There's also a shift around philanthropists asking community leaders for their input and partnership on how to best deploy funds. So for the practitioners on the call, research the growing community of giving circles and philanthropic partnerships as potential funders, but also consider creating partnerships for your specific organization. So thinking through that will be really key for all of you. Okay, so I'm sure many of you have heard the term trust-based philanthropy. It's a buzz phrase, and I'm laughing because it's Big Buzz Idea Group. But this is really a buzz phrase. But at its core, trust-based philanthropy is rooted in a set of values and a set of practices that help to advance equity, to shift power, and to build mutually accountable relationships across funders and practitioner organizations. The Trust-Based Philanthropy Project is a 5-year funder initiative with an informative website that we've cited here. It addresses inherent power imbalances between foundations and nonprofits. A critical element of this is shifting the onus onto the funder in terms of due diligence before funding decisions are made, and thus reducing the amount of time nonprofit organizations are spending on applications and reports. Along with this is the notion of unrestricted funding and perhaps multi-year funding, creating space for organizations to get beyond the hamster wheel of constantly seeking money to keep the lights on and pay staff. What I'm going to focus on here is really offering support beyond the check. It's an area where I see a ton of opportunity to make a real difference, particularly for smaller organizations. What else can we offer beyond financial support? Of course, many of you on this group call have heard of Mackenzie Scott. She's given away billions over the last few years, unrestricted, to organizations where her team did the due diligence in advance. No owners, paperwork, etc. Many organizations that we've worked with have received this and then said, what now? What does this additional fiduciary responsibility mean? Many organizations don't have the access to the networks of professionals with finance or legal expertise. So we built actually an entire curriculum to support our foundation clients and our nonprofits in readying themselves from a fiduciary perspective for when that transformational gift happens. So key questions to ask yourselves. Do you have a finance and investment committee? Do you have an investment policy for short and longer horizon funds? A spending plan for different pools of assets? Messaging for how funds will be spent, both near term and long term, so that other donors don't mistakenly assume you don't need their money anymore. All of this will be incredibly important. All right. So to wrap up, the Nakubo report showed continued consideration of responsible investing and DEI around the investment managers populating their investment portfolio, an effort to make an impact or not undermine mission with the corpus of the investment portfolio. We also learned that social enterprises are key. More and more consumers are voting around their wallets, creating more opportunities for nonprofits to partner with corporations for diversifying their revenue sources. So through products, through contracts, et cetera, not just grants. This is somewhere where organizations can really think critically about work that they can be doing. We've also seen activity of business priorities and structures, such as B Corps as a corporate designation. That means something. Patagonia's recent transfer of shares by the family into a nonprofit entity, that shows there's really appetite for these private and public partnerships. I believe that if we look 10, 20 years into the future, the traditional foundation funder grantee organization model is going to look very different. The lines are blurring. People are voting with their wallets, and business models and products and solutions are going to develop as a result. So I believe we're going to have greater benefit for more people and for the planet as we look outward. It's really just getting through the process of getting there between now and then. So I will pause here and see what questions you all have, and I will take down the slides.
That was a lot of information in a very short amount of time. I'm also just wondering if anybody wants to revisit any of those pieces. I know the 5 trends slide was very interesting. The trust-based philanthropy slide was very interesting. Does anybody have any questions at this time? I think the other thing, Sepora, that I would love to kind of ask about, I mean, I love the broad range, right? And in the nonprofit arena, one of the things that I think is so interesting when you study the stats is how few organizations actually get over $1 million. So I think I would love to talk a little bit too about if an organization hasn't started their investment process. I mean, I love that you have a checklist. I love that you have resources for that. You know, at what point should an organization start thinking about their investment policy and start making, you know, setting the finances aside to start, you know, just get started?
Yeah. I mean, I think it's never too early to start. I think that there's obviously like there's 2 pieces of it, right? Part of it is ensuring that you have enough per day to day, right? And so I'm in no way at all saying forget having a cash reserve, forget having operating reserves, go all the way into investment. I think first and foremost, it's most important to build that cash reserve. But I think having an investment policy, even around that shorter term bucket, is really important. And part of the reason I say that is because you're never going to really know if you have enough, if you haven't done the work around ensuring what is enough, and also then really created guidelines around that bucket. And so I think the sooner the better. And what I will say, Melissa, to your point as well, is that having having your board really involved in that piece, especially at the beginning, is really important. It's staff of the organization has so much that's on their plate, so much that they're doing. So if you have a board member that has some familiarity with whether it's the financial space, the investment space, banking more broadly, I would engage that person early and often to ensure that they're really thinking through for the organization and are part of that board as a working member of the board, to help partner with you on that. I mentioned already we have the cash reserves analysis tool, and I'm happy to share that with the group. But I think as a starting point, at a minimum, thinking about having that 3 months in cash and working to get there, that'll help an organization really, to your point, grow beyond that million, right? Because once you have a cash reserve, you can start to look forward. You're less worried about just meeting day-to-day expenses.
Yeah, I think that that's really important. I think the whole concept around, I remember my first stint as an executive director, we had one board member who really felt that we as an organization should be reinvesting all of our money annually and not setting anything aside. And lo and behold, I'm old enough that, that was before the recession of 2008 and before the pandemic for sure. And so I think as we've seen these things happen over time, right? The most sustainable organizations really are the ones who have started to do those set asides, build the investment funds, have their money working for them, and kind of thinking long term, right?
Absolutely. I see a question that came in. I'm going to answer this live.
Great.
So the question is, what's the best approach to reach out about giving circles? What should be the steps? So I mentioned looking into what giving circles are in your area or are giving to organizations that maybe you fall within the overall like category of. So I think first identifying the circles will be really important. And I think that's also, again, something that you can ask your networks, right? So asking whether it's your board or other folks who are involved with your organization, hey, are there any giving circles that you're aware of, that you know of? Could you connect me with folks that are, and it doesn't even need to be the decision makers, because in these giving circles, the majority of them, any member can put up an organization to be included and to be looked at as a potential, grantee of the organization. And so I think it's important to think about who's already in my network, how can I connect with them, and can I just directly ask them? Because that would be my first recommendation, is just to directly ask them, what giving circles do you know? Are you on these giving circles yourself, or do you know someone that is involved with them? Can you put in my organization as one of the organizations that they look at? Let me know what you need from us. But I think that starts with really doing the research and seeing what organizations are around you, as well as just asking around within your own networks. Does that help answer the question? If not, feel free to put another question in the Q&A.
I think it does. And if I remember correctly, you also had that link to that source in the presentation that that we can share out following, and make sure everybody's got that as well, because yeah, I feel like there are more giving circles coming up. I know there's been a lot of groups that do quarterly come-togethers, and they each give like $100, and then they have the organization's pitch even, and then they decide who's going to win the money that night, in that round. I do think giving circles is a new way that people are pooling resources together to make bigger impacts.
Yeah. And to your point, Melissa, on that slide, we do have the Global Giving Circle directory and the Regional Philanthropy Serving Organization. So links, so both of those, and I'll share, both of those are places to start that research. So I appreciate you bringing that up.
But even conversations, right? Because not everybody might be on that list, and there could be people in your own community. And so talking about it and asking the questions, I think sometimes if you don't know what to ask, right? There might be something in your backyard you're not even familiar with.
And again, I think asking your board, asking whether it's however you're set up, asking the folks who are involved with the organization, have a stake in, ask them to ask their networks, right? I think just asking the question will go a long way with giving circles, especially because they are looking for organizations to give to. And sometimes you just may not be on the radar. They're not thinking of you. You haven't asked the question. Similarly with requests, right? If you don't ask, you're not necessarily going to get the additional funds.
That was a powerful statistic. The concept, right, of just if you ask them. We've got a couple of organizations we work with right now who are very focused on making those asks, focusing on the bequests. But then not only with your 1/3 of people will do it if asked, but then the concept too that they give more in their lifetime leading
Yeah.
up to, the future bequest. I that really floored me. I had not heard that before.
Yeah. It's crazy. It's crazy is not the right word, but it's really impactful. But I do think it is in some ways crazy that we don't think about that initially on the nonprofit side until it's brought to our attention.
Yeah. So I love some of the resources that you have for organizations that might be kind of early on in this investment process. But I would love to also talk about kind of just reiterate or clarify any tools that you have right now for any organization that might want to follow up with you and do an analysis. What does
Yeah.
that look like? Is that a long process? How much of a lift is it for them?
Not a long process. So we have a questionnaire. It's our cash reserves analysis questionnaire. Um, from that questionnaire, and I think I saw somebody on the call who may have already completed it, and hopefully I'm correct in saying that hopefully it wasn't a huge lift. But it's really just answering some standard questions about the organization, where things sit from a revenue and expenses standpoint, how you normally expect funding, all of that. When that comes in, like what percentage is from one-time gifts versus donors versus government funding, all of that. And then what we do is once that questionnaire has been filled out, it takes only a few days. Our team analyzes the questionnaire and really provides results. So we run it through this analysis and we're able to really come up with, okay, this is the optimal size of cash reserves that you should have. So depending on all of those different things, I will say the minimum is always 3 months. So if you're just starting out, try to get to 3 and we can always go from there. But do you need really 6 months? Because there's facilities that you have that are older and may need repair, and you could need money from them that could deplete you fairly quickly. Or maybe you need more than 3 months because there's oftentimes a break between when funding comes in and when you have those expenses, and sometimes you're short, right? So being really thoughtful around that piece, I think, is important. So I would say that isn't a huge lift. It's just as long as you're familiar with what the organization is currently doing, you should be able to, from there, fill that out with some ease. And then on our end, it'll take a couple days and we provide you with an analysis and some thoughts also on how you should be investing this cash reserve. With where cash rates are now, you are able to actually get paid on your cash finally. And so when I say that, I mean, if you put your dollars into a money market account, a lot of those money market accounts right now are earning around 5%. If your money is sitting in a checkings or non-high yield savings account, it is probably not returning anything. So it's worth doing this exercise because that 5% could be a lot. And what we are recommending actually right now is a blend of money market and also some very ultra short bond funds. So just to think about ways that you could be really optimizing that cash, I think the money market is a great place to start. Really think critically about where your cash reserves currently are and are they actually making any income? And if not, could they be? Again, a conversation to have with your banker, your investment manager, whoever you're working with. And I'm happy to jump in as well with it.
I was going to say, we'll make sure to include your information in the follow-up as well. Just so that if people, again, the tools and want to follow up with you, want to reach out to you. I think this was just a jam-packed information session this morning. And really appreciate you being with us. I'm not seeing any other questions. And so with that, thank you again, Sepora, for spending your morning with us. And I hope that everyone has a wonderful day.
Thanks, Melissa. Thank you, everyone.